Real stories, expert insights, smarter decisions.
Well, you can't wait to digest your strategy, see how we can learn more about all the amazing work that you've been doing.
Tune in and find out.
Well, good day, everyone. My name's Liam Garman. I'm the host of Inside Residential Property, brought to you by Rethink Residential, part of the Rethink Group. And a lot of our listeners would know Rethink because of their amazing commercial insights. But for IRP, we're going to go through some of the amazing strategies from proven investors in the world of residential property. In this podcast, it's not going to be about hotspot chasing. It's not going to be about buying units or apartments off the plan. We're going to unpack how you can build bespoke and tailored property investing strategies. And I am joined by the man himself, Scott O'Neill, who's going to be joining us for this episode of The Journey. Scott, Rethink Residential, talk to us about it. What's the goal? What's the strategy behind that move?
Yeah, look, I'm super excited for this. I remember when I was a first-time investor, the one podcast type I'd listen to was other investor stories. You know, it's all great hearing theory that may change decade to decade, but like just hearing what others were doing in the current market, like that gave me motivation. I was learning from others because you're not really exposed to much of this, like especially when we're talking experienced investors. Like most of us don't have a friend or a direct friend doing that. So just hearing what other investors are doing, the numbers behind it, I got a lot of value out of it. So super excited about this podcast because we're just going to be doing the same thing, and we're going to like dissect their portfolios as well. So we'll provide advice, our opinion. I think we're in a unique position in the market as one of the oldest buyers agents in the industry. We've been buying thousands of deals for over a decade now. So we've seen multiple cycles, and there's a lot of kind of buzzwords and hotspot chasing and all that kind of stuff going on. And the industry is really fueled by whoever is the best salesman over a podcast has the biggest buyers agency business, and that can cause issues as well. So we just want to break it down to basics. We're long-term investors. Call us boring investors. We don't buy off the plan. We're not trying to do crazy developments in a market that doesn't make sense in the current market to do so, but we know what works. And we also have got a loose line towards potentially pivoting at some point in your portfolio towards commercial, because at the end of the day, we believe you need cash flow to retire. And there's no focus on that. It's only capital growth, this industry. And we see so many people with these large portfolios that are hemorrhaging 200 plus grand a year just to hold on to the things. You know, you're working for your portfolio, not the other way around.
I think there's a lot of investors now. You know, I'm an Instagram fiend. I spend hours and hours a day on socials, and it is really common that, we're off the back of over the last 6-7 years, just bumper growth across probably every market, maybe not so much Victoria, but really every market across Australia has had bumper growth since COVID. Some of them double-digit year-on-year returns. And what that's done, in my opinion, has shifted the discussion from what you're saying, really smart long-term strategy building, where people want to balance equity with cash flow, balance resi with commercial, and tying it all in for a holistic strategy. What that's done is, I see it on socials all the time where you're 100% right. It's hotspot chasing a lot of time. And you do run the risk, and while it can be a strategy for some, you do run the risk that you might be the last person into that hotspot. And with the off-the-plan stuff as well, I see it all the time of buyers, agents out there that might be getting commission from both ends. And so what we're looking to do on Inside Residential Property is take people on that journey, get real investors in, talk to them about their real strategies of how they've built a portfolio that's going to last the test of time.
Yeah, and look, I'm really excited about where the industry is going. Like when I first started, there was probably 20, 25 buyers agents in the country. There's somewhere between 5 and 10,000 now.
10,000.
They're everywhere, and that's I think overall a good thing because there's a lot more help out there. But there are things we'll call out, over these podcast series about things to watch out for. Like one fairly topical one at the moment is there's a lot of people that have all the same data analytics program. So the data hotspot is a genuine theme that people need to be wary of because they will find somewhere that's cheap and has good yield and tight vacancy rates. And then they flood the market. Some of these buyers agents have the ability to oversupply the demand of that market tenfold. So what happens is they artificially increase the value of that market, and you'll get those rapid capital growth rates that they'll all quote. You might get 20 to 40% in 2 years, which is amazing. But then what happens is once those investors stop pump in the market. It goes back to the natural equilibrium of that market because the locals haven't had 40% pay rises. It's just new money into the market. And then there's a worrying theme that I'm seeing some people actually then tell their investors to sell out, but not all of them at once. So it almost becomes a little bit of a, I wouldn't use the word Ponzi scheme, but a pump and dump strategy. And that's not good because, breaking numbers down. Let's use this example. If you buy a 500 grand property and it goes to 600,000, everyone will say it's gone up 100 grand. But the reality is you've spent about 16 grand on stamp duty. You've got your legals in there, a couple grand, costs, other costs in there. You might be doing building and pest reports and, that's going to cost you money, but then you've got to sell as well. So you've got to pay a sales agent, it could be 10, 12 grand as well. You've still got solicitors again. You've got other costs that might be another 10. So overall, that 100 grand has about 40 grand costs. And then you've got to pay capital gains tax on it. Even if there's a capital gains discount, you're left with 42 grand. And that's before you paid for a buyer's agent. It's before you've accounted for the negative cash flow over that year or two. So you can't pump and dump or buy and sell in this country. It's not a flipping culture like the US because of all our taxes and the horrible costs of buying in and out. So we really got to get people back into the long-term hold mindset. And this is where you don't chase a hotspot. The numbers will not benefit you long-term. Like they'll see the short-term thing and the argument is, yeah, I can refinance and quickly go into another hotspot. But if you then bought in all these subpar areas, and there's plenty of that happening at the moment, these small regional towns, you might get the next Perth or the next Darwin where it goes quiet for a decade. Getting 20 to 40% quick growth is no good if you get no growth for the next decade. So we want to just get back to the old fundamentals, which the majority of Australians follow, but it's not spoken about as much as it should be in the current play of podcasts out there.
Oh, I couldn't agree more. And that is why today we've got someone who's on that journey. G'day, Vincent, you there? Let's see, this actually works. Hey, Vincent, it's Liam Garman from SPI. Welcome to the first episode of Inside Residential Property. Thank you so much for joining us today. Yeah, good. Yeah, excited. It's going to be our first episode today. 8 properties since COVID. It's bring a pretty amazing growth trajectory for you. Can't wait to digest your strategy, see how we can learn more about all the amazing work that you've been doing. Yeah, fantastic. We're going to patch you through now so all of our listeners can hear you. Yeah, sweet. That'll be coming through now. So Vincent, tell us a little bit about yourself. How did you start your property investing journey?
Started my property investing journey in, I want to say 2021, towards the end of 2021. So I'm sure I listened to a lot of different sources of information, podcasts and stuff, probably for the better part of a year or two before I actually jumped and made my first purchase with a bit of assistance from a buyer's agent. Kind of 4 years later now, accumulated 8 property assets and just in the process of building a granny flat as well. So yeah, still exciting times ahead.
That's fantastic. That's really some substantial growth over such a few years. What motivated you to get into property investing?
Probably a confluence of different factors, but of course, probably more to do with my upbringing. Didn't grow up not being looked after or anything like that, but in a working class family, so always trying to strive to achieve more and kind of create a more comfortable life for myself and my family, future family.
To grow to 8 properties over, was it 4 or 5 years, is a really fantastic growth journey. Scott, what was the kind of strategy that underpinned that growth?
Well done, Vincent, on getting on almost the perfect time. After COVID, it was a bit slow and then just went crazy. So definitely capital growth is the main play here. But one question I had for you, Vincent, is, with the granny flat, how much did that end up costing? Because there's been about a 50% increase in prices.
So I remember having some conversations about building a granny flat many years ago, actually earlier in my portfolio. And so even just comparing it to now, I'm actually still in the process of building it, but the rough cost for a 2-bedder, 60 square meter footprint in northern Queensland is, I think we ended up around the $230,000 mark. But I do remember initially getting some quotes in the mid-hundreds. So there has been quite a big increase in terms of just any kind of trade work or building work.
Have you done the numbers on how much equity that will increase the property by?
Well, I'm not expecting to increase it significantly in terms of a capital uplift. I'm more just getting it more to manage my cash flow, particularly because this particular asset is held within a trust structure as well.
Mm-hmm.
It's more just to manage the cash flow and hopefully enable further acquisitions as well.
Yep.
Yeah, so hoping to at least get a 1-for-1, or hopefully not to be stung by it costing me more than the equity or the capital uplift. Yeah.
And what kind of rental income are you looking per week for that one?
Probably in the vicinity of 5 to 550. Probably just need a few more conversations with my property manager to understand the market at the time, and also just consider whether the cost would include utilities and things like that as well. So it's still an ongoing conversation, still pretty early on.
You've got quite a substantial portfolio across Queensland, Victoria, WA. I'm looking at the figures in front of me now, and that's quite substantial growth. It is fantastic to see. 8 properties in total. Can you give us a bit of a time sequence? What came first? How did you acquire 2, 3, 4, 5, 6, and so on?
Long story. Don't know how much detail you want to go into, but it started off, like I said, with a bit of help. First property was in Norlane, Victoria. I want to say the end of 2021. So the idea behind that first purchase, this is me going in very young and naive as well, as I still am. It was to buy and hold. I think after about 6 to 12 months, there was enough equity based off the val with a prospective lender that we could strip some equity out and then make a purchase for the second property. And that was in Eagleby, Logan area of Queensland, southern Queensland. From there, I believe it was another bit of time before we made the next acquisition in Western Australia. It all kind of blurs into each other, to be honest, in terms of the sequencing. But we made 2 purchases in Western Australia, one in Forestfield, which is quite close to the airport. After that, we made a purchase in Kelmscott, so kind of further south in Perth. We made a regional play after that, and this time strategically putting it in my partner's name and getting her involved as well with her first investment property. We made the first purchase for her in Harristown, so kind of Toowoomba off Queensland. From there, we made another regional play just to get some diversity and capture some of the hotter markets regionally in Queensland as well, once again in Rockhampton. So that's had some good growth as well. And the more recent acquisitions in the past year, you can appreciate throughout the journey, there's been a lot of start and stop points, just trying to catch up with income and cash flow and managing other affairs as well. But the 2 most recent purchases in the past year, the first one was in a trust with a corporate trustee. That was in Kalenga, so going back to Queensland, northern Queensland. And the last or most recent purchase was in my partner's name, hoping to catch the upswing just in regional Victoria, so in Bendigo.
So it looks like you guys jumped across some real growth areas between Queensland, WA, and now in those regional Victorian markets. So you've gone from boom to boom to boom, leveraging your upswing. Vincent, you used Right Property Group for the first 2 and then worked with other agencies afterwards. How did those experiences differ?
Some were really good with communication. Some were really good in terms of due diligence. All had their strong points in different ways. But I guess learning of my experience working with different BAs, it did give me quite a bit of confidence to give it a crack myself, particularly with more recent purchases. So I think only time will tell kind of how those perform.
Scott, I'll throw across to you for this because I think a lot of our listeners would be dialing in and saying, like, Vincent's had such a good run. Like, you've hit a hotspot. Of course, property investing is more than that. And there might not always be the 10, 15% year-on-year growth in some of these areas. What are ways that investors can take a journey like Vincent's and learn from it? What can they do tangibly in their journey that you're seeing at the moment?
Yeah, well, look, Vincent's portfolio journey's obviously been a very good one, and he's now at a point where you've got to work out exactly what the net cash flow is of this portfolio, because you're thinking, how can this make me retire in X amount of years? So a question for you, Vincent, what is the total value of the property, all the properties combined, and the debt levels at the moment?
So I'd say probably at current market val, we were looking at circa 5.2 million in net asset value.
Yep.
And the total debt is sitting at about 3.7 million. And this is not factoring in kind of the next step with the granny flat. So it'll just bump up the net asset and the net debt.
It's a great position to be in. Have you done any calculations on what income this is generating or negative income after maintenance, vacancy?
Just with some conservative figures, taking into expenses, interest, current rent, I'm probably sitting at about the low 90s pre-tax in terms of negative cash flow. And then after tax, that'll just be whatever my marginal tax rate is, so 30, 40-ish percent coming back towards me.
Yeah, so I guess this is a really common situation, like because I obviously work a lot in the commercial division. Even Phil, who I do the other podcasts, similar portfolio, just a little bit more advanced, I guess, in timelines. And the job from here is how to turn that cash flow from negative 90 to, hopefully plus 90 pretty quickly. So that would be almost, your true North Star for every decision you make forward, because you've got, 8 properties. That's great. You don't need 20 of them. And there's a lot of that kind of theme in the market, especially with the buyer's agent industry, because it's all about transaction numbers and that gives revenue to business, all that kind of stuff. So there's a bias towards just buying lots of properties rather than getting income, because we're here to retire. It's not to collect as many toys as possible. It's to develop an income that you can sort of step back from work. And you've got a really good foundation to go do that, because let's say your $5.2 million portfolio grows to 10, that might take 12 years or whatever it is. And if your debt's still around 3.7 in that time, you're in a really good spot. But there's ways to fast track it, which we can go into a bit later. But yeah, great spot. Diversity, I love the diversity. The locations you mentioned are pretty good, especially for the dollar amounts you're spending. So yeah, it's just about further diversity and switch that cash flow equation around.
What are ways in which people can, go positive? Negative 90 a year would, for a lot of our listeners, almost be, stomach churning. In terms of stress, because you still have your rent, you still have your own maybe PPOR mortgage on top of that. What are the first stages? Would you look to start consolidating the 8, the ones that have the most equity, start selling them down? What are the next steps?
One strategy would be for Vincent to sit tight for 2 years, for example, build up as much equity as possible, refinance all the deals at once, and do 100% lend into a large commercial asset. So you might be able to free up a $800,000 deposit, and then you put that into call it a 2.5 mil commercial property that might have a 7% net income, and the cost of debt might be 5.5% at the time. So it's a 1.5% margin on the 70% leverage, or 100% leverage in this case. So it will actually do a pretty big cash flow hit in a positive way for the portfolio. So that's one. And probably selling older assets that have high maintenance costs. Like there's definitely going to be an older one in that, I assume. That's costing you $5-10 per annum on not just cash flow, but then there's maintenance costs annually on top of that. So even selling can turn the cash flow equation around by 10-20 grand by just not even buying, just selling. And then hopefully you can redeploy that money into a higher income asset.
Those are fantastic insights. Vincent, when you first started your property investing journey, did you expect that you would acquire 8 properties? Or was your initial play that, hey, I've got some money here, I'm going to buy 1 or 2 to set myself up? And then at that point, you got the kind of growth bug and you wanted to acquire and potentially get that passive income?
Definitely the latter. Didn't kind of go into it starting with the idea of acquiring 8 assets or X amount of assets. It was more just with the end goal in mind of, setting myself up for whatever that may be, optionality. And it's just kind of throughout the journey led me towards that point, towards continuing to acquire more. So it's been more kind of just the journey itself and the position I've fortunately been able to be in to allow me to continue to accumulate in.
There'd be a lot of people that work with Rethink that would be in Vincent's shoes, right, where they don't really know the art of the possible. When I look back at my own investing journey, I'm from Sydney, and I was like, well, I'm not ever going to be able to get into the city market, so I'll just dabble around Australia. And then I realized, well, there actually is pathways here, whether it's the passive income or to get wealth, to get financial freedom. Is that a common thing that you see with your customers or your clients rather, that they don't really know the art of the possible?
Exactly what you're in. Don't buy in Sydney, buy somewhere else. It's cheaper. Plus the yields are better as well. Like average yields out there are somewhere in the 4 to 4.5% rate in the buyer's agent industry, which is a lot better than a lot of the stuff you're seeing in Sydney. So by diversifying out, you're going to get better cash flow and have multiple assets. The trouble is you just keep going too far down that one strategy. I did it personally. I bought 19 properties before going into a different asset class, and my issue came from banks saying no more, and I was forced out of the market because of that. Even though I had equity ready to go, I couldn't deploy it because my income plus the rental income was not enough to service the current debt levels. So it does become a showstopper, and with the trust setups and companies out there now, you can get around that a little bit more, but it doesn't solve the underlying cash flow issue. Like you're just kind of moving around it, which, you got to go back to the fundamentals. It's not about how many you can buy. How do we get that income? Even if it's break even, that just changes the ball game a lot too.
For sure. You're, Scott, known as Mr. Commercial. I think it's a very reasonable thing to say, but your company, Rethink, does do so much work in the resi space, and sometimes we can forget it. And even your own property journey, as you highlighted, getting 19 residential properties puts you in the 0.01% of property investors in Australia. What was your personal journey?
Well, look, on the business side, we've been buying resis for 10 years now. 2015 is when we started. We were doing higher volume, and the industry was a lot smaller back then. So I loved resi. It was the way to get ahead, and it's still the way to get ahead. So I'm known for commercial, but I still recommend everyone starts in residential. Like portfolios like Vincent's, perfect. I look at this and go, he's going to be a very good commercial investor one day. You just got to start thinking about it, and you don't need to sell your resis. You might just refinance them. But we're like, even back in 2017, the company was doing 45 residential properties per month. Yeah. So we were all over Tasmania, Brisbane, to all over Australia. And I pivoted towards commercial personally and from a company point of view because I saw it wasn't the way to retirement. You can't buy 20 resis unless you've got a very high power income behind you or you're a business owner. And then a lot of our clients weren't that. They're everyday people, getting everyday salaries. So the solution to help them get ahead was a bit of a mix between commercial and resi. And by pivoting the Rethink business towards commercial, we dropped massive numbers. Like I basically lost money for about 2 years because we went from doing 45 deals a month to like 5 commercials because no one wanted commercial back then. The education was terrible, and there's a lot more out there now and the volume's there. But I just did it for the client's sake. We thought you just have to diversify, and the product made more sense at the time. But we never stopped doing resi. We just stopped marketing it.
Is there a risk, because there's going to be a lot of people out there that might be in Vincent's position and they've hit that cap, whether it's a serviceability cap, but they might be considering commercial too soon? What can that do to their portfolio, and what would you say to them?
Well, one of the reasons for this podcast is too many people think about commercial too soon now. Like we have 150 people a week reach out. 90% of them aren't suitable for commercial because we want experience behind you. You need a certain deposit level. Like you need about 400 grand deposit to buy a decent commercial. You can get them cheaper, but you're playing in a high risk space and you're better off sticking to resi.
What would high risk look like? A retail or something?
Yeah, just smaller tenancies. Imagine buying a 40 square meter retail shop. You know, it's going to be cheap, but it's going to have a tiny tenant that's going to either grow too quick or vanish because they don't have the experience or the volumes behind the revenue. Same with warehouses. Like, yes, we play in that space because we have to, but you really want to use a bigger deposit to invest well in commercial. And residential, as Vincent's proven, goes really well if you do it right and buy in the right areas. It's just like I'll keep repeating on this podcast, you got to pivot at some point. Everyone pivots at a different point, though.
And one thing Vincent's doing very successfully with his strategy is that his later properties have development, residential, potential renos, granny flats. How does this tie into your strategy, Vincent? And can you give us a look under the hood, Scott, after that, about how this changes his position?
Like I mentioned, there's one property in northern Queensland at the moment, specifically Moreton Bay, that we're currently pursuing building a granny flat on. We're just in the DA approval process, just given some specific characteristics of the block. It's just needed to go through DA. So hopefully the intent behind that is to bring the trust to neutral, if not positive, at some point to allow me to continue just with ongoing acquisition. And then after that, just pending conversations with my broker, depending what serviceability looks like, everything like that, it'll either be another acquisition or it might be pulling the trigger on another granny flat on the property in Eagleby, so South Brisbane. So it's kind of just playing it by ear at the moment, but everything's more just trying to bring the cash flow to reign before potentially pulling another trigger for an acquisition, whether it be something residential or whether it's an opportunistic time and it makes sense to pivot into commercial.
Is this something that you've done a lot of?
Yeah, and look, full disclosure, we've steered away from granny flats in recent years just with the build costs have gone up and also the time to construct. It's really blown out. There's not enough people working in Australia building houses at the moment. It's the biggest problem with one of the biggest problems with the elections and both sides of politics at the moment. And what that does is it takes a bit of the shine off the granny flat strategy, because if it costs more, like Vincent's numbers, like 230, if you're getting 500 a week, that's very good. But questions are like, you know, what's the net income? Are you losing income on the front house because you're splitting the block? How much deposit do you put in that? Like it does, when you compare the numbers to maybe if I just put that, you know, in a separate house with its own land, maybe it's sometimes better just to acquire more land and go for more growth. Especially if you fall under the one-for-one, you know, value proposition you mentioned, Vincent, because if you buy somewhere else, you're going to be way over the one-for-one, you know, because you've got a whole new block of dirt to do things. And especially with commercial, the same deal. You're going to get growth and also, you know, basically better cash flow. But yeah, one granny flat, that's great. Just would be careful doing that repeatedly, because especially at your age, Vincent, I think acquiring more land makes more sense. You know, if you can hold these lands for 50 years and it doubles 3 times in that period, that's better than a granny flat that's depreciating over the same period from an overall wealth point of view.
I have, from a podcasting perspective, I'm in a very fortunate position that I do get to speak to some of Australia's best buyers agents like yourself, Scott. And there has been a re-pivot from the development, renos, granny flats mindset from precisely your reason, which is that build costs, labour costs have gone so high. Think of it if you buy an off-the-plan property, or if you go look for a knockdown rebuild. There are knockdown rebuilds where the price of the building is 2-3 times the land and existing established property that's on there. And when you factor that in, well, the acquisition growth strategy of just buying more land and waiting for it to naturally appreciate seems to be the most financially wise.
100%. Well, for the first time in Australians' history, the average cost to build the average house is over $500,000. So a lot of these cheaper properties are around that price, plus you're getting the land. So you are buying below replacement costs, which is important. And I see all sides of this too. One of my major sources of new high net worth clients for commercial, these are ones dropping millions for a deposit, are developers not developing. They'd rather buy the local shopping centre and say, I'll cop a 6-7% return on that, plus get growth. Maybe there's value add play there. That makes a lot more sense than building, 10 townhouses. So yeah, right now it doesn't make much sense to develop in general.
Unless you've got perhaps the background, the connections that you can do it yourself. This is something that we hear about with renos all the time, especially if you're listening to this podcast and you don't necessarily have a background in it. I think one of the challenges is every Aussie thinks they know how to do it. Every Aussie thinks that they're a tradie. It's like, well, it's actually a lot harder than you think. It's a lot more time, a lot more expensive than you think. And when you do have to bring in the experts, when you do have to take time off work and all these things, there are a lot of hidden costs that sum very quickly. something as simple as a tenant being out a few months longer than you think blows out your position so much that you didn't factor in your strategic planning. A lot of people would be listening to this. Vincent, 29 years old, 8 properties, and it is truly inspirational. However, I can only assume that there would have been some hurdles, challenges along the way. It's never as simple as just buying 1 or 2 a year. What are some of the challenges that you've faced?
A lot of things around unexpected costs for maintenance. So whether it's like a water heater or, leaks in the roof or things of that nature. So always just being mindful of having buffers in place just to address those kind of things, especially when you're kind of, rallying up on your acquisition journey and really pushing too close, flying a bit close to the sun. So just kind of trying to rein that in at the same time. And then other barriers or difficulties along the way would have been more around the financing piece. So once again, with these minimum wait times of having to refinance or knowing that you've got to wait a certain amount of time for valves to stick up before you can refinance to pull out equity, or even just having to improve one's own situation in terms of just income earning potential. I reckon from the start of my property investment journey, I've probably been through about 3 or 4 jobs or roles, just trying to be able to push myself to continue to progress as well. So lots of challenges in that sense, but it's been fruitful.
The buffer is incredibly important. Have there been people that have fallen trapped to that in your journey that you've seen?
Not in recent times because the market's been so good. But yeah. I remember just before I started investing, which has influenced how I've invested, it's just before the GFC was there. I remember there's a lot of people around specifically Southeast Queensland buying hundreds of properties, much older than myself at the time. But basically when the Royal Commission happened with the banks, their lending capacity had major restrictions and these guys lost most of their portfolios. Yeah. So I always kept that in the back of my mind. Just make sure you keep things above water. Treat it like a business because the current policies with everything we've got right now will always change. Maybe for the better, maybe for the worse, but plan for the worst scenario because then you can hold through that period. And yeah, congrats to Vincent hitting it in such a short period. And yeah, I think you've done everything right. I'd just like to see plan for the worst case scenario just in case things do tighten up. There's a lot of job losses and stuff like happening. Not to be negative, but this is how you got to think, especially when you've got a serious portfolio. Like there's a 5 million valuation plus there, and it'll be 10 one day. You got to think about these things. Just don't think always just redlining it. I used to, and it's pretty stressful doing that as well. You don't need to do that forever. Like you've got the base there. You're 29, big portfolio. You've kind of done the hard work already. It's now just time.
I think those are good insights because you can't assume that growth is infinite, right? You can't assume that the 10, 15% return year on year is always going to be there. If you look at markets like Darwin, which, a lot of property investors are talking about moving into, if we take the calendar back, it had about 10 years of no growth. So it's growing now, which is good, and it's probably a delay on 10 years. But it was stagnant for a while. Perth before that. And Vincent, you've had some great growth in WA. WA had like 14 years, the data better than me, 14 years of flatlining, which is why you got bargains, right? Yeah. Because the underlying value of the property was way higher than what it's actually valued at. But it is a risk because growth is never infinite. And all it is, what you were saying before, Scott, about our inability to build. If we did have a government policy come out which radically reduced the cost of building and supply radically increased, the scarcity is gone. And a lot of the underlying value of these properties might go under. So you do have to have that in the back of your mind. You have to be quite risk averse at times.
Well, look, the good thing about, for property investors at least, I can't see how they're going to change the supply issue in Australia. Like, especially how governments run, it's always short-term decisions. Like, look at the first home policy, like give loans to people with 2 or 5% deposits. There's no address there towards the supply. They're creating more demand. They're just going to push the prices up. So they're not helping anyone really. But they're helping Vincent with his properties because they'll help push values up in those price points.
So the government moved their first home buyer guarantee up from, I think it was 1 Jan, it was originally coming in. Now it's 1 October. Scott, you're a property expert, so it'd be great to get your opinion on this. My outside look in, you've got people coming into the market with a 5% deposit. You've got some state governments. Now it's not uniform across every state, but there are also some state governments that have increased first home buyers grants. I'm looking at Queensland primarily, where you've got the first home buyers grant going up. The threshold for stamp duty concessions also going down. It looks like there's going to be billions of dollars coming into the market that actually they were not here last year.
Yeah, and it's going to be people with 2% deposits and 5% deposits. So imagine having a 98% loan and it's your first property. You're probably buying a unit with strata as well. Like, I just can't see how that's a good idea. Like, sometimes renting is better, but there's an obsession in Australia to you've got to own property. And the people that are going to get pushed into it, they're getting pushed into a pretty, I guess, competitive market already. So are they going to get rapid capital growth? Argument is no. I think they've missed a lot of the boat. They're playing in a price point where there's a surge of new interest as well. There's no new supply kind of coupled with this new volume. So the supply-demand ratio is going to be off again, which pushes prices up short term. And then do these people have the ability to pay more quickly? Probably not. So that, indicates a spike in growth and then flatline for a bit. And this is what always happens when they do these schemes. It's they roll it out every few years. It's kind of a go-to playbook by both sides of governments.
And that's it. It's in the supply-demand equilibrium. It is just stimulating supply. It's stimulating demand rather. There is no solution to rapidly onboarding new properties to drive property prices down in some areas. Like you're a very ethical investor, and I don't think, Scott, you want to see young Australians out of pocket. But it is schemes like this where, if I were to do the maths, very simply, if you were to do the maths and Sydney's first home buyer guarantee goes up to 1.5 million. So you got a 5% deposit on that, 75,000. Now you do have to pay stamp duty because that is just above our stamp duty concession. So you will have to have stamp duty on that. But you're asking someone, if you're taking out a mortgage, which is essentially going to be at least over 1.3 million, your repayments per month, they're going to be what, $7,000 a month repayments. It puts a lot of young people in quite challenging positions because they've got deposits which are the equivalent of less than a year's worth of repayments. Yeah. They don't really have a long-standing demonstration of being able to repay their mortgage, and now they're going to be getting mortgages. I do see that there's going to be a lot of people entering the market, but then that reinforces the reasons as to why, if you're going to get in the market, you have to be smart about it. It's not necessarily going into the suburb that your parents bought because you know it, because I can guarantee a lot of your friends from high school or university or work are going to be doing the exact same thing. You're going to have to look for those strategic loopholes. And whether it's, you're working with a BA, even if it's for a PPOR, or acknowledging that, maybe I'll forego. Yeah, I think in New South Wales, the first home buyer's grant is still only about $10,000. Well, I'm going to forego that and go into an area which is going to be more primed for growth, because I can say hand on heart that hotspot growth area where obviously we don't necessarily want to focus on hotspots, but those areas where you do have good economic indicators, it's not going to be over leveraged, for example. Those areas are more likely to be wiser investments than, say, the off the plan unit.
100%. And I bring so much back to cash flow. Like, if you go buy that PPOR and it's probably going to be a unit or a townhouse, like those repayments you mentioned, they're going to become the biggest boat anchor to your life. In the most difficult financial time of your life, you'd strap to that. It could be 10, 20 years. And yes, you might not even be living in a suburb you want to be. So what's the point? Just so you ticked off, I own a property. Like, is your ego worth that much to destroy your life financially? Or do you just go, I'll become a rent investor? Like, I've rented more than I've owned properties or lived in them in my lifetime. And I actually like the flexibility. You could sort of move when you needed to. And yes, it's tough. And yeah, you can't, do everything you want to the property, but who cares? It's a small sacrifice compared to having that, $7,000 a month invoice coming through from the banks in interest. And And the argument is, well, I'm missing out on capital growth. Well, you only miss out if you haven't invested elsewhere. Even if you bought stocks, and they're doing okay. Like the opportunity cost is less as long as you've invested somewhere else. So I wouldn't look at these incentives unless you're one of those rare people that live in the right suburb where the fundamentals actually stack.
Yeah, and that is rare. You can't assume it. And with the growth of that, people getting that FOMO, it's well, you actually might not be missing out on too much. Keep in mind, you're coming in and you're buying at the same time as potentially millions of other young people. You're actually buying at the top of that wave, potentially. Not in every area, but you will be buying at the top of that wave. So realistically, you might not be missing out unless you're maybe the first person in on October 1. You got your pre-approval. Your broker knows how to set everything up so it goes on that day. You found the place. Yeah, you might. Reasonably you might, but not many young people are going to be in that position. Given that Vincent, 29 years old, there's going to be a lot of people listening to the podcast. Whether they have a brother Vincent's age, or a son, or a cousin, or a daughter who's young, and they're thinking about this, and they're thinking, oh, well, this is just your opportunity to just go and get on that ladder. What would you say to them? Like, what advice could you offer them?
I'd just avoid government incentives if you can. Because remember, the government's only introduced incentives to try either stimulate growth. They're trying to get votes. Just like stay away from that. Like any good economic investment is not propped up by government. It's propped up by the private sector and the general economics of supply demand in that region. It's like, you wouldn't invest in shares because the government's just stacked something up in it, because what if they take it away? Then the void becomes there and then you don't get the growth. Like all these markets you were mentioning before, like Perth has gone through the roof, but before it didn't grow for 12 years. Growth on average might be, 7, 8, 9% per annum compounding over the years. So if you get 40% in 2 years, that's either playing catch up or it's going to then not grow for quite a while, because unless something massive changed in that suburb, like they built some kind of new hospital that brought all these new doctors and they're all paying significantly more rent. But most of these areas don't have that type of influence. It's just investor demand is pushing it up. So yeah, this is where you got to be a long-term investor. You don't want to go in there and chase a bit of a bubble growth, whether it's from government incentives or, investors getting a little bit too crazy. Play the long-term games, and if you get that 7% compounding per year and you can manage your cash flows, it's really the only way to make money long-term, outside of doing developments and other stuff.
And that's where you get into the negative equity risk, which is if you go into that area where, say it was a growth area 20 years ago and there were a lot of young families back then, and now they've got a bunch of Australians, 25 to 35, and they're all buying in that area. And there's an influx of buyers. And then it tapers off in a few years. And because you've got a 95% mortgage, 5% deposit means a 95% mortgage, right, at the end of the day. Yeah. And most of your repayments are interest, and you haven't put much principal down. You haven't paid it off much. And there is even the slightest road bump. It could be the closure of a hospital, or it could be that the new hospital that was going to be open has been delayed 10 years. And you're like, this is a golden ticket to my equity. And then it's been delayed by 10 years. And then house prices dip 5-10%, you're in negative equity territory now. It's a huge risk. Even in my own life, my wife and I, this is an example I always bring up about why young Australians listening to this podcast have to firstly work with experts, but also don't just fall into the trap of, I'm just going to buy a PPOR, the box ticking exercise that you said before, Scott, because it's something that we fell into. And we bought our apartment a few years ago, and the apartment next door went up for auction, and oh my gosh, if I told you, it's gone up a little bit over years. And I'm looking at it, and it's just, it's opportunity cost, right? Yeah. Not to mention that, when you've got a 30-year mortgage for the first couple of years, you are paying interest, right? So being strategic with your buys, not just buying something for the sake of buying something.
Yeah. And look, one of my rules with investing, like I bought one apartment, same as you, like it was our second property, and we did it because we're living in it. It's the biggest regret ever because it barely grew. There was all these strata issues. It was in Maroubra, decent suburb in Sydney. But we lost money on that because we had to buy and sell out of it in a shortish time frame. The growth was nowhere near what our other investments were getting, and plus the negative cash flow was, tens of thousands a year as well. So, yeah, no, I think you just got to. I think as a general rule, you need a really good reason to buy a unit, because the only place supply can come up in volume is high-rise apartments.
Yeah.
You know, like I was listening to Harry Triggerboff talk about the other day, the only way to fix the supply problem in Australia is if councils rezone large swathes of middle ring suburbs around the capital cities and then just pump 20-story buildings in it. That's the only way to do it. Like, you can't build more land. Like, you can urban sprawl out, but then you've got our cities are incredibly inefficient. Like how far is Penrith from the city? Like 60, 65 Ks? Like, yeah, you can go out 100 Ks if you want, but that's not really a
People aren't going to commute on a 2-hour train.
No. And then, like, how many can you still build? Like, we've got 1 million extra people in the country in the last 12 months. Or, you know, the immigration levels are slowing up now, but they're still renting and they're still causing more, I guess, demand issues. So it's good to be an investor because they're mostly going to be renters as well. That's why we're at record low vacancy rates in most places across the country. But yeah, I just don't see how a PPOR, if you're kind of not financially made it or set, it doesn't make any sense for quite a while. And that's, you know, all my friends and family are in the same boat. They just delay that until they've got money to splurge.
If you could go back in time, starting your investment journey, what would you have done differently?
So hard to say. Maybe just get more involved in the process, get myself educated more from the start. But at the same time, I hesitate to say that because you can have all the information in the world, but then it's all about action and executing as well. So hard to say. Otherwise, something else that I wish I probably would have gotten started earlier on was maybe getting my partner involved a bit earlier. Just more from an educational piece and bringing her along the journey. That would have been a lot more fruitful, and I guess kind of just sharing that journey would have reduced, you could say, the risk and the stress on one person, you could say.
Now, that is all we have time for. Thank you so much today for joining us on the podcast, Scott.
Thanks, Liam.
Now, if you did enjoy today's podcast, please share it with your friends and family and follow Rethink on socials. Reach out to the team there, go on their website, and they'll be more than happy to support you with any advice or help that you might need on your property investing journey. But until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.